Well. Hello, old friends. How are we doing today? It is a great pleasure to be back on YouTube, streaming live from TrendSpider TV. My name is Jason Krutzky. And it's been a while since we've done this. We used to do this quite often, and then we kind of fell off the wagon for a little while, focused on some other things, and now we're back to doing these lives. And what these lives are really all about, I see there are a few of you here. I want to thank you so much for being here. And what these lives are really about is this is an opportunity for you guys to ask me questions, get your answers answered, get your questions answered. Anything that you're curious about regarding the TrendSpider platform, you want to talk particular tickers, you want to take a look at some charts and do some analysis. I'm kind of here to be a voice of TrendSpider and just to kind of help you guys along the way. If anybody has any questions about anything, that is my big purpose here today. Now, there is a secondary purpose, of course. It's FOMC day, as everybody knows. And so we're going to be hanging out. I've got Jerome Powell all loaded up. He is right over there. You can kind of see him. And he's going to be coming on here in about an hour. So we're going to get the announcement in 30 minutes, right at the top of the hour. And then he's going to come on and do his presser at about 1:30. And so I'm going to tune into that. We'll turn down the music. We'll turn up his voice and we'll listen to what he has to say. Now, I've been kind of scouring the internet, listening to all the spaces and kind of catching the lay of the land of kind of what everybody's expecting. If you are not sure what to expect, my general, what I've kind of gathered from smarter people than myself this morning is pretty much everybody is expecting a pause today. They're not going to raise rates is the expectation of the crowd. And so if that's the expectation of the crowd, then we kind of got to assume it's a little bit priced in. And so it's going to be all about then what he says going forward. Did they over tighten? Do they have plans to tighten further in the coming months? That is the big question mark. Now, it seems from what I can tell, from what I've heard, again, smarter people than myself, it seems a little bit mixed. You know, some people are already of the assumption that he's over tightened or that the Fed is over tightened. Some people are under the assumption that they have not tightened enough yet and that they will need to continue to. I'd be curious to know what y'all's thoughts are. There are a few of you guys here. So please, in the chat, say hello. Let me know your name. Let me know where you're tuning in from. And most importantly, let me know if you have any questions. Like I said, I'm here to assist with those. I've got the SPY chart up here, and I was kind of thinking over the next 20 minutes, 15, 20 minutes or something like that, we could kind of just do a quick little review of some of the big, the indexes and maybe some tickers that you guys happen to be watching. If you want me to take a look at some of the tickers that you guys are watching, happy to do it. And then maybe about 5 minutes or so before the announcement, we'll pop over to multi-symbol view here and we'll load up whatever ticker you guys want to watch. Robert the Great, hello from New York. How's it going, Robert? How's New York looking today? Is it cold? Is it cold there today? I'm in Colorado, and we got nailed with snow over the weekend, and it's slowly starting to melt here. But curious about how New York is looking. So yeah, if you guys have tickers that you want to make sure to be watching, I can pull up 16 of them here on the trusty old multi-symbol view. So leave those tickers in the chat and let me know, and I will get them loaded up so that we can all watch the thing that we want to watch at 12 o'clock, or I guess at 2 o'clock. Like I said, I'm Mountain Time, so. Is it possible to use TrendSpider with interactive brokers? It is, yeah. So the way that you would be doing that, presumably what you're asking is connecting your TrendSpider alerts to interactive brokers to, use your alerts as signals to get into and out of trades. So what you would want to do there, let me go to Signal Stack. This is our order routing product. So what I would recommend is take a look through Signal Stack, go to that supported brokers and kind of scroll through here just to get an idea of, here's your interactive brokers, get an idea of everything that's available to you with that. And there are some updates coming. I can't speak to them just yet, but there is actually a pretty cool, pretty exciting update coming to the platform here in the not so distant future. I'm not going to give you a timeline because I don't want to jinx it. But in the not so distant future, that's going to fully expedite this process as well. So excited to launch that here soon. So let's talk about SPY real quick. You know, if you guys follow us relatively regularly, then you know that I write a weekly blog update, and in that weekly blog update, I highlight weekly charts of the three major indexes, SPY, QQQ, and IWM, and just kind of, you know, let you guys know what we're seeing out there, what TrendSpider is identifying, and what we're kind of seeing. And you know, the big thing I think on SPY this week anyway was that that point of control from the beginning of this year. So this is automatically anchored. The platform automatically anchors to the year to date. And I can see my volume distribution here, of course. And I've got my point of control. That's where the most volume at price has occurred. And then I've got my VWAP, and you can see what they're doing right now. They are just grinding right in between those two very, very important levels. Not surprised to see, you know, they talk about these big volume areas acting as springboards for price or acting as resistance for price. Well, we got a perfect bounce off of that level. And now they're right up into the VWAP from that same spot from the beginning of the year. And so this is the average price that all of the buyers from the beginning of the year have paid right here at about $420, getting rejected at it today. You've got the 200-day moving average right there as well. They gave a little fake out below this descending channel. Again, platform automatically identifying this descending channel using the chart patterns tool. And so, you know, they tried to kind of scare people out with that trend line break, kind of a false breakdown. And now they're stuck between the 200-day moving average and this VWAP from the start of this year. So these are it's not a surprise to see us getting caught up here. It's going to be very important to get back up and over this in the days and weeks to come. And we can kind of talk about, you know, if you guys wanted to do some strategy testing later, we could talk about when SPY breaks below the 200 or something like that. You know, we can test these sorts of things to see how does it tend to do. So that's kind of on the SPY, that's really kind of what's caught my attention. You're stuck just below that VWAP from the year to date. You're stuck just below the 200-day moving average, but we're holding this giant point of control where all of this volume is. If they do want to continue lower, you know, you've got this volume gap here around $400, $403, $402. I would imagine that if they are able to get below this and start closing properly below it, you're going to see those 400 levels hitting sooner than later. But until then, you know, you got to kind of keep an eye on this 411, 412 as, you know, your key level of support for the time being. If we switch over to the QQQ here, not quite the same look, but pretty similar. We've got kind of a similar downward sloping thing going on. It's not quite a proper channel, so the platform didn't identify it as a channel, but you know, you do have this kind of area here. They're kind of very similar look, right? You're holding that 200-day moving average. Instead of the point of control, it was really about the 200-day moving average. They did a little fake out below that downward sloping trend line, and now they're coming back into it. So we're going to be keeping an eye on, you've got the 50-day moving average up here in blue. You've got that point of control. So this thing lost its point of control from year to date, you know, like 2 weeks ago. And so perhaps it wants to come back in up here around this 365 area. I don't really know. You know, today's going to be, I would imagine today's going to be pretty volatile in about, you know, starting in about 20 minutes or so. So we'll see what happens there. You've got the VWAP below the 200-day too at about 335. You do have a very small volume node here. So we know that those volume nodes kind of serve two purposes. Price can really just jam right through them and just right through low volume nodes, but also price can interestingly find support at them. It's kind of like an odd thing that price does sometimes do. It'll come right to a really low volume volume area, and then it'll bounce. So, we pretty much got that bounce just a couple of days ago, like I guess that's last Wednesday, Thursday on the 26th. And, maybe if it does continue lower, then maybe we don't have as high of an expectation for a bounce next time, since it's already happened one time. The IWM looking awful. Everybody knows it. These guys are paying mega interest rates these days, all these companies. So they're struggling, right? And it's just trading below everything, everything of all importance. It made a new it made a new 3-year low last week, which is pretty unbelievable, but that's what it did. Made a new 3-year low, trading below the point of control from year to date, trading below the VWAP from year to date, trading below the major moving averages. The only thing that it's kind of done, it's trying to hold the bottom of this descending channel. So we'll see how it sets up. Really kind of got to zoom out quite a ways to be able to, gain a bigger picture of this. So what I'm always going to do on the weekly, pull this back, anchor to those COVID lows, get an understanding of where things are at per those COVID lows. And again, we're trading below point of control, below VWAP. You've got the fibs. Grab a fib tool real quick. You do have the 618 fib retracement right here at 152. That's the next reasonable fib. You could see they were trying to hold that 50% fib retrace. They've been trying to do it for a year, and they've just broken down below it. So perhaps if we do get a move higher, you might want to keep your eye on that 50% fib retrace. That's at like 170 or so. The top of the channel up here, you've got the point of control, the weekly point of control from the COVID lows, all in that 170 to 173, 174 area. If this does want to reverse and bounce higher, might be keeping an eye on that as a potential spot for where it could get rejected next, but we'll have to wait and see. So those are kind of some thoughts, some very basic thoughts on the indexes. I'm curious to know, what are you guys watching? Are there any particular tickers that you're really interested in trading today? How are you thinking about trading today? Are you the type that thrives in the volatility of an FOMC day, where you often will get huge moves both up and down, depending on, if it starts moving down, if the initial move is lower, then Jerome comes back and very often that move will reverse while he's talking, or vice versa. I'm curious to know kind of how you guys think about trading these days. Do you sit on the sidelines? Do you like to trade them? If you like to trade these days, how do you best prefer to do it? Some friends of mine love to sell, options on days like today when there's going to be lots of volatility. Maybe you've got some sort of iron condor or something like that going on. But I'm curious to know how you guys like to do it. Me personally, I like to sit on the sidelines. I've made enough mistakes trading days like today to know that it is absolutely best for me personally, for my style of trading, to sit on the sidelines, let the price action play out, come back to it tomorrow when things are a little bit calmer. We do have other stuff going on this week, though. On Thursday, we've got initial jobless claims. So tomorrow, that's initial jobless claims at 6:30 or 8:30 Eastern, 6:30 for me. And then we've got non-farm payrolls on Friday. We've got Apple earnings tomorrow after the bell. We got a lot of stuff coming into the end of this week that could potentially bring quite a bit of volatility to the markets. So today is just one of many action items to be really, really mindful of. I think it's going to be a very volatile next couple of days. And so therefore a very tricky trading environment. And I can only hope that you guys are fully prepared. And, like I said, I'm curious to know what you guys are thinking about trading today. Hit me up in the chat. I'm really, really curious. I want to get to know some of you guys. There's 32 of you guys here, and only Robert the Great has said hello. So please say hello. What's your name? Where are you tuning in from? Are you currently a TrendSpider user? Are you here because you're curious to know more about TrendSpider and you're just you're thinking about perhaps becoming a customer. You're thinking about signing up to the platform. You've seen some of our videos online or something like that. And maybe perhaps you heard that we just started our infamous Black Friday sale. We're doing this a little bit differently this year. In the years previous, it was a fantastic sale, but it has never been a better sale than what we're offering right now, up to 82% off if you sign up during Black Friday, which is pretty crazy. That is a wildly good discount. We offer in all the different tiers of plans. You can go monthly, you can go yearly, you can prepay. If you decide to prepay without a trial, then that's going to be your best deal that you're going to be able to get. And if you want to take it a little bit slower, maybe, try it out for a couple of months, start with a monthly plan. You can always switch. The world is your oyster. Bill Flappin, customer for a couple of years. Shout out, Bill Flappin. Props to you, sir. I'm so, we're so thankful. Thank you so much for being a customer of ours. We are honored to have you around for the past couple of years. What are you trading today, Bill? Bungles, how's it going? Good to see you. Where are you guys tuning in from? The main benefit of TrendSpider if trading SPY. Well, it really kind of is dependent on what you're after, right? The whole idea behind TrendSpider is to offer you everything that you need without having to go elsewhere, look elsewhere for information. So, depending on your skill level and where you're at as a trader, there are tools for beginners, there are tools for experts, there are tools for everything in between. Alex, what's up from Lubbock? From Chicago. Ooh, is it freezing cold in Chicago right now? I have to assume it is, Bill. So, starting off, anything from the auto analysis tools. Auto fibs. This thing will automatically draw a fib sequence on the most recently completed move. Automatically will draw trend lines for you if you have trouble knowing where to draw your trend lines. I know that it's a bit of an art. This thing takes that maybe art, or it takes the personal biases out, utilizes just sheer math to determine where the most powerful trend lines are. This thing can automatically identify tons of different candlestick patterns, tons of different chart patterns, from broadening ranges to channels, double top, double bottom, head and shoulders, triangles, wedges. And you can use all of this functionality pretty much across the platform. So if you want to be alerted on particular conditions being met, you can automatically create alerts on any visual element of the chart. So like I just clicked on this 50-day SMA, just right click on it. I can create a price action alert on that SMA directly. I can create what we call multi-factor alerts, and using those multi-factor alerts, I can create multi-factored conditions, price conditions, indicator conditions, candlestick pattern conditions, and utilize up to 4 different time frames. So if you are, again, this is getting into the more advanced trader mindset, but if you have a very deep understanding of and you have a very specific set of conditions that you're looking for, you want to see RSI here on the hourly, you want to see price taking out a new range high, you want to see, above average volume on the daily, you want to see whatever it is, any mix of different conditions that you want to define, you can do that using multi-factor alerts. You're going to get the alert. The platform is going to automatically watch the charts for you and kind of let you know when your specific conditions are being met. From there, you've got the market scanner. Market scanner can search for all kinds of crazy things: price conditions, indicator conditions, candlestick pattern conditions. You can look for chart pattern setups. Maybe you like to trade specifically falling wedge patterns. Well, we can do it. And everything's pre-built pretty much for you. So falling wedge breakout scan, I can run over here, grab my falling wedge breakout scan, run the scan, and I can automatically find, let me turn on some falling wedges here. They are turned on. Let me make sure they are visible. There we go. So We've got a falling wedge. I'm going to turn off my indicators just so that we can see this. We've got falling wedge turned on. We've got the breakout out of the falling wedge. Let me turn off my channels here so that we're only seeing the falling wedges. So, take this and extrapolate it out. If you have particular, I don't know, anything that you might like to trade, you could pretty much find it in an instant. And again, that goes for price action conditions, that goes for indicator conditions, candlestick pattern conditions, chart pattern conditions, earnings dates, earnings values, dividends, splits, news, analyst estimates. You can get very, very nitpicky here with this and really kind of go down some serious wormholes. Again, you can utilize 4 different time frames here as well. So you don't just have to, you're not just stuck to one. We've got this. What's happening now is like a mini Bloomberg terminal. You can add what we call widgets to it, and what we're looking for here is just a whole swath of different things. I've got news events. This is a live feed of news events that are coming out. This is a live feed of insider trades. We've got earnings announcements. So, in order, or you can really kind of filter these however you want. Specifically, just analyst buy ratings that have come out today. You've got large out of the money puts. We could go really, really down some serious wormholes, but just the basic idea here of kind of taking this more fundamental data, putting it on your dashboard, filtering it to what makes sense for you, whether that's, out of the money calls being bought above the ask, or that's, every name that has earnings today, or that's just news items for Apple today. Think deeply about what it is that you're wanting a direct feed of, and you can kind of launch all of that here in what's happening. And it continues on and on from there, from strategy testing. You can, one of the biggest pieces is being able to take the strategies that you love to trade and see how they actually perform on the asset that you love to trade them, see how they actually perform on the assets that you don't particularly trade that much. You may find some alpha in trading something that you never traded before, utilizing a strategy that you particularly like. And again, with the strategy tester, you can utilize price conditions, indicator conditions, candlestick pattern conditions, one time frame for the strategy tester. Once you find things that you like, though, speaking back to you, Robert the Great, once you find setups that you like, maybe you find a strategy that performs really well on a particular name, it's a couple of clicks, launches a trading bot, go over to your Signal Stack account, throw in a webhook real quick, and you're kind of off to the races. This thing can automatically just essentially like forward test for you. If you don't want to hook it up to anything, you can utilize it as a forward testing mechanic, but you can hook it up to your broker, and you can turn essentially strategies that you build into actions that trigger buys and sells for your strategies. On the right-hand side here, there are quite a few widgets to choose from. Now, these widgets are, as I said, absolutely send to Twitter. You can send alerts or your buy sell signals. You can send them to Twitter. You can send them to your Discord. Anything that accepts a webhook, you can send your stuff out to. So, if you have a little channel that maybe you're the trader of all your friends and you like to give them signals for different things that you're taking, you can employ that way. On the right-hand side, you've got all of the widgets that come in what's happening now. And there are a couple of other things in here too. You've got your trading bot widget, so you can kind of see whatever you have set up. If you have anything set up, you have seasonality. Seasonality is something that we point to a lot. If you follow us on social, you see us pointing to seasonality often. You can get a good understanding of the seasonal performance of your asset that you're tracking, that you're trading. It just gives you a bit of a overlapping picture, or like a longer term picture of, how does this asset perform historically in Novembers, or how you can measure a lot of things. You can measure how often in a particular month it trades above X RSI value, maybe above 70 or below 30, or above the 20 SMA, above the 50 SMA, above the 100 SMA. What percentage of the time is it above these moving averages during these months? And then you can break this down even by weeks. You can break it down by days of the week. You can break it down by hour of the day. You might find some alpha on a particular name that says, over the past whatever couple of years, Apple tends to trade really poorly in the first hour and really great in the last hour. And perhaps maybe you might use that information to develop a strategy that buys Apple in the first hour and sells Apple in the last hour. There's lots of different ways that you can utilize the platform. And it's just a matter of how deeply you're thinking about things and how deep you want to go. You can kind of go as deeply as you want to go. You can keep it at very face level, just utilizing those auto analysis tools, or you can really dig into strategies and try and develop things that, allow you to take your hands off the wheel and let the platform kind of run the whole show for you. We are 5 minutes away from the announcement, you guys. So I want to pass it over to y'all, and y'all tell me, what tickers do we want to watch going into this thing? Anything on your mind, anything that you're interested in paying close attention to on this announcement? Leave those tickers below. I've got Bitcoin here. I've got UUP. That's the dollar index, the ETF of the dollar. I've got the Qs. But I'm leaving the rest open to you guys. So y'all let me know, what tickers do you really want to watch here over the next few minutes? TLT, let's do that. There's TLT for SDW. How are you doing today, SDW? Tuning in from the great white north. Apple. We got SPY up here, Patrick, right here, top left corner. Pins. All right. Pins had earnings recently, didn't it? I feel like I heard people talking about it just recently. All right, we're going to zoom out a little bit on these guys because we don't know. We don't know what price action is going to do, so we want to zoom out a little bit and see these things a little bit more clearly. What else you guys got? Any other tickers? The stage 2 accumulation that ever. Yeah, it's Pinterest. I mean, how are they making their money? They're making their money on presumably just ads? Do people sell things on Pinterest? I guess they have to, right? NVDA. Y'all are gonna mess around and let SDW decide every ticker that we're watching here. I know he's picking the good stuff though. But sometimes in the past when we've done these, you guys have picked some very interesting charts to watch. So that's why I didn't just want to like preload it with stuff that I thought you might want. Anything else, guys? I'm going to throw ETH up there. What about some... I don't know, maybe some healthcare or some... I don't know, Caterpillar. Let's do Caterpillar. Bueller. TQQQ, huh? All right. Stop spamming. Nightbot getting mad at USD. Sell H. I haven't looked at this one in a while. 2 minutes, y'all. 2-minute countdown. Ooh, Sell H got whacked, huh? Did they have earnings just recently? I'd have to pop over to the other chart to see. I bet they did. Looks like they did. XLE. Great choice. Let's go. CL1. Some crude oil futures. You can't really see it great. Here, I'll do like that so you can kind of see it. I'm blocking the crude oil futures ticker, and I apologize. All right, 1 minute warning. What do we think, y'all? Higher or lower? Higher or lower? Initial move. Let's do that here. Or, yeah. Initial move. Fairly muted. But definitely higher. TLT moving. Bitcoin doesn't really seem to care. Dollar a little lower, but not much to see there. XLE not displeased. So, as expected, obviously, Fed is paused, keeping rates unchanged. Fed holds benchmark rate in 5.25 to 5.5% target range. Fed says tighter financial credit conditions to weigh on economy. Fed repeats it will assess extent of additional policy firming. So now it's all about Powell. If we're going to get some big reaction, it is going to come in the form of Jerome Powell in about 28 minutes. So not a huge surprise. Yep. Retraced and now bouncing again. Pretty muted response, which to me, again, kind of suggests that market was anticipating it. So then it's just a matter of perhaps what Jerome Powell has to say. And will he give us something that's slightly unexpected? Will he say something that's slightly unexpected? I'm curious to know. And we will find out here sooner than later. So I'm curious then, y'all. We've got about 25 minutes before Jerome comes and talks to us. Is there anything that you'd like to kind of take a look at while we're hanging out, waiting for J Powell? Ooh, gold. I haven't thought about gold in a minute. We should take a look at gold real quick. Because I know that lots of folks have been talking about gold. Let me take a look at it. I'm going to pop over here to this big chart and kind of see what's going on. It's like we got some old stuff here. Man, what a move over the past couple weeks, huh? Regaining that 200-day, regaining everything, regaining the 200, the 50, regaining the point of control from year to date, regaining VWAP from year to date, and doing it with like just no trouble at all. Initially, you saw a small rejection here at 177 off the 200, off that point of control, but man, wow, pretty incredible. And then they've come back in, for those of you who are price action folks. Let me change this. This is my auto fair value gap indicator. It may not spot that one. Make this a little smaller. Yeah, it's because there's a gap there. But for those price action folks, you do have fair value gap right in here. And they're rejecting right in it. Not a huge surprise to see that. What they do here is pretty important on gold. Very interesting. Let me zoom out a little bit more. Yeah, wow. It's an impressive move past couple of weeks for sure. What's up, Eco Signal? How we doing? Andy, you want to take a look at Pfizer? Let's take a look at Pfizer. So on the weekly, platform is identifying this falling wedge breakdown, coming right into those COVID lows. Pretty make or break spot here, I would say. Daily, weekly, monthly expected moves. Also curious if there's any simple way to port TV Pine script over to TS JavaScript. All right, so daily, weekly, monthly moves. What I would say for that is I would pop into seasonality and I would turn on mean change. So mean change will give you an idea of the win rate of the month. So how often that month is green. The seasonality is default set to a value that tells you the percentage change for the month. So if you have a green candle, then you've increased from open to close. And if you have a red candle, then you decrease, right? So if percentage change greater than 0, we're talking about green candles here. So 42% of the time, Januaries are green for Pfizer over the past 50 years. Its best performing month is November. Its mean change in November is 2.88%. So that can give you a little bit of the idea of what you're after for the monthly there. You can switch this down to the weekly if you want to. And you'll still be able to see that mean change. Mean change for this week. Well, I'm sorry, what week are we? We're week 44 here. So mean change, 55% of the month, or 55% of this week's over the past since 2004 are green. You can also get an idea of projected outcome in the strategy tester. Strategy tester has a tool. Let me show you. Strategy tester, I'm just going to throw any random strategy here. So just keep in mind, we're not trying to like make a kick-ass strategy here. We're just using any old strategy, but I'm using it to show you, well, I need to find something that is in a trade right now. So let me just pick a strategy until I find something that this name is actually in the trade as we speak. And then I can show you there's when a strategy is in a trade currently, it's going to project onto the chart a cloud. And we call that cloud essentially like the behavior explorer. So here's a good example. On this particular strategy, there's a 15-minute super trend MACD strategy. You can see it beats the asset over the same period of time. I guess this asset's been in a pretty deep drawdown, so not hard to do in this case. This isn't a great strategy, but it does give you an idea of that projection. So this is this strategy and all of its returns. Every single time it's gotten into a trade, this is traded 125 times, or these conditions have occurred 125 times over the past 13 months worth of data. And based off of all of the historical returns of this strategy, you get this cloud. So the bottom of the cloud is like your lowest win rate, or your lowest win percentage over time. The top of the cloud is kind of the max that any individual trade has gained. So you have this projection, this cloud projection of a year's worth of historical trades. This is how they tend to perform after you get into the trade. This is how the stock tends to perform. So you can kind of just keep your eye on this cloud. Is price trading within this cloud? Let me show you kind of like this, right? Is it kind of bopping around, doing something like that? Is it not following? Is it not respecting the cloud? You know, there's different ways that you can kind of think about this. If it's kind of respecting the cloud, that's great. Maybe perhaps you're staying in that trade longer and longer, right? And if it starts not respecting the cloud, you're probably going to get out, right? Your exit conditions are probably going to be able to get you out. But if you notice something instantly that kind of goes against the natural tendency of this strategy, it could be an early, it could be an early signal for you. So I would say those are the two tools that I would point to as like ways to gauge expectation that the platform is going to automatically do for you. There are tons of ways to gauge expectation, but those are the ones that kind of are top of mind for me. SDW. So getting to your question about PineScript to JavaScript, that is a little outside of my wheelhouse. I have to admit, I am definitely not a coder in any way, shape, or form. There is not like that I'm aware of. There may be tools out there that will transfer Java or transfer Pine to Java, but I am not currently aware of them, unfortunately. Now, SDW says, I know in some cases TS will convert. And that is true. If you have a particular indicator that you're interested in converting over and you're having trouble, there's never any reason why you can't reach out to us with that request. Now, whether or not we can manage that request for you is not completely guaranteed, but we do have a team on hand right here behind me. You can see my cursor down in the bottom left-hand corner behind my picture. There's a contact us button. And if you click that, it's going to open up chat. And here you can talk to these guys. There are guys live every single day, Monday through Sunday. And during the week, it's about 20 hours a week. On the weekends, it's about 8 hours, I believe. Last I checked, that might have expanded. But there's almost always someone around you can ask a question to. So if you have a particular indicator that you'd like to get switched out from Pine to Java, you can always ask them. You can always request it, and perhaps it can be kicked over to somebody on our development team, and they can help build that for you. So what I would say with that is make sure it's a really cool indicator, because the cooler the indicator, the more likely they're going to build it. Is what I would say. You were thinking of near dated at the money straddle. Yeah, gotcha. Can someone still get the discount if they already have an account? Patrick, how long have you been a user with us? And what are you currently signed up for? Like, what account do you have? Do you have a monthly account? Do you have a yearly account? Oh, Alex, cool. That's a really cool, that's a cool video. And I'm actually working on a new one right now. So ICT, the big obvious tools are fair value gaps and 1 to 2 months monthly account. Patrick, hit up support. Click contact us. Tell them you want to take advantage of Black Friday. Tell them you've been with us for just a couple of months on a monthly account, and they will assist you. They will tell you what is available to you. So Alex, let's talk about this. Now you're talking my language, my serious language, like the way I trade language. One thing that I am working on right now. So like you saw, I make videos on trading concepts, and I've been working through a handful of different ICT, price action, market structure related concepts. And the most recent thing that I'm working on that we'll probably go live with in the next week or so is all about trend. It's like trend basics. And you'll find, if you have not yet studied trend basics, you will find there is a ton of overlap between market structure and ICT and just these basics of trend. You'll find that fair value gaps seem to kind of fit in with lots of very simple trend basics. So this video is really cool in that it utilizes an indicator called zigzag. Don't know if you know anything about zigzag. I can throw it up here on the chart real quick so we could take a look at it. So what zigzag is, and let me turn off a few things real quick just so we're only looking at one thing here. So zigzag is going to automatically plot just the big swings. If you're a price action trader, then these key pivots, higher highs, higher lows, lower highs, lower lows, these things are going to be very, very important to you. But if you have trouble kind of identifying the key pivot areas, zigzag is a means of tuning out all of that noise. Awesome. Okay, cool. Alex, so this could be a game changer for you potentially. Especially if you already have a good understanding of the concepts. If you don't have a good understanding of the concepts, that's what this next video that I'm making, or that we're in the process of editing right now, that's what it's for, is to explain some of these very, very basic concepts of trend and how to utilize zigzag to identify different trend scenarios. So what zigzag can do, like I said, it just plots major swing points. So if you have trouble looking at this chart and identifying where the absolute swing high or absolute swing low is, you can turn on zigzag and see it. But the second thing that zigzag has, favorite Dan Ushman story regarding TS. I don't have one, but perhaps he's tuned in. Rainbow, what's happening, man? Hope you're well. One thing that you can do on our zigzag indicator is you can turn on levels. And the levels functionality is a game changer for me personally. This was a request that I actually made, because now you can define the horizontal levels of the most recent pivots. So the 5 most recent pivots. If you know anything about Wyckoff, there's a video on our YouTube channel all about Wyckoff accumulation and distribution. If you don't know about Wyckoff accumulation distribution, I implore you to check out that video and kind of learn the basics of Wyckoff, because you'll start seeing those setups kind of on all time frames. You'll start seeing them all the time. And zigzag is an excellent way of identifying Wyckoff accumulation distribution, which is an excellent way of kind of getting into a trade right as that trend is kind of changing. But the fact that we can identify and define these 5 horizontal levels from the most recent pivots allows us to do lots of different things. So if you go into your scanner and you type in market structure, this is going to yield a bunch of scanners built off of zigzag. And they are very, very basic. But as a price action trader, these concepts are actually really basic, and you can trade off of these things in a really basic kind of way. So I've got 6 new scanners. We haven't even announced these yet, but they are live on the platform if you're a user. That look for 6 different setups, 3 bullish ones, 3 bearish ones. So you've got simple uptrend new high, you've got simple downtrend new low. So for example, all we're looking for here is this, right? You have made a new high and you're making higher highs and higher lows over the past 5 pivots, but we've just recently made this new high. The simple downtrend new low looks for the opposite of that. It looks for stocks in a consistent downtrend, and you've just created a new low, right? Your A is lower than C, your C is lower than E, B is lower than D. So these are like proper price action downtrends, uptrends. You've also got simple uptrend pullback. So you've made a new high. Now you're coming back into the previous range. We have simple downtrend bounces, right? So here's your new high. You're coming back into the range. You've got simple downtrend bounce that looks for the opposite of that. You're in a downtrend, you're bouncing, and you're coming back into the previous range. And then you've got the beginning of downtrend reversal, beginning of uptrend reversal, which are both break of structure. They look for break of structure. So you're familiar with these ICT concepts. You're likely very familiar with breaks of structure. So in a break of structure to the downside, you're seeing a new high being made, a higher high. In a break of structure to the upside, you're seeing a new, reverse that. In a break of structure to the upside, you're seeing a higher high being made when you were in a downtrend. In a break of structure to the downside, you're seeing a lower low when you've been in an uptrend. So we automatically can find all of that stuff using these 6 scans. And in this video, I discuss kind of like how to think about using these scans. I share ideas and all that sort of stuff. So I would recommend, Alex, keeping your eye on our channel and watching that video when it comes out. And in the meantime, play around with these because it's wildly powerful. They're very simple ideas, but also very, very powerful if you know how to trade this way. It is kind of a unique style of trading. And I don't talk to a ton of folks that really trade specifically like this, but really fun to trade this way. I find it to be really powerful, and so that's why I've created this video on it. Awesome. Right on, Alex. You've used the strat for trading. You're learning ICT. Yeah, so the strat and ICT are they're like brother, sisters. They definitely vibe with one another. They're not quite the exact same concepts, but very similar mindsets, I believe. So there's really only the one Wyckoff specific video, but we talk about Wyckoff in multiple videos. We're kind of suggesting Wyckoff in a handful of videos. Really, when you think about breaks of structure, what that really kind of is those are Wyckoff. Those are kind of Wyckoff setups in a way. Like this is a really good example, right? You were in a downtrend and then you made a new high. So you broke structure when you made a new high relative to C, and then you're looking for this pullback. And this is essentially an inverse head and shoulders, right? Is what you're getting. You have your shoulder here, you have your next shoulder kind of in here. And so you would utilize this as an opportunity to take a long. You'd be using your B as your stop, and then you'd be looking for targets higher than A, right? But what you essentially did is you had a Wyckoff kind of accumulation thing in here. They broke down. You have a little bit of a spring where they do like a fake out breakdown, and this box could be wider even. It could be like this. You have this fake out breakdown where they take the bottom of the range, immediately reverse it, and then they go and they take the top of the range. And so in Wyckoff theory, you're looking for that spring, you're looking for the move to the new high, and then you're looking for the pullback for the long opportunity. It can always go different ways, but that's kind of the theory behind all of it. And this is the first indicator that we had that really allows us to easily define this sort of stuff. We can take a look at kind of how we do it, but it's all pre-built for you. But if you wanted to define it in another way, you certainly could, but you can specifically pick the level, right? You could even say, you can make it much simpler than this if you wanted to, but these are just kind of what it takes to find these complex setups. I'm going to pop back over to the major index here. I'm going to turn off zigzag. Yeah, so markets are really just waiting for Powell here, aren't they? Looks like we got about 6 minutes or so until he goes live. Sometimes he's a little slow to get into it. And also sometimes, I will say, sometimes it'll go live and not actually tell me that it's live. So if you guys notice that it's live, I'm going to have this. Let me get this thrown up on my screen here. You guys can kind of hear that music in the background. Turn that off for a split second. Let me turn J Powell on. This is our man J Powell. And I can kind of put him anywhere. Maybe we want to put him like right here. All right, so we are all ready to rock here for J Powell. Do y'all want to watch up maybe just a couple of tickers? Maybe do like a 2x2 so we can see things a little bit more clearly. And if so, anything in particular you want to... Any strong feelings about what we're watching? Put up a little energy. Put up a little TLT. We got the SPY. So just so we're all aware, if you go to TrendSpider.com, if you're interested in taking advantage, if you're interested in taking advantage of the Black Friday deal, just go to TrendSpider.com. Go to the pricing page. Very, very easy to find. If you are ever interested in asking questions, and I am not live because obviously I'm not going to be live all the time, but we are going to be doing this pretty often, at least over the next month. If you're ever interested in getting some questions answered directly from me, let me give you guys my Twitter. I've just added my Twitter to the chat at Krutzky Trades. I am an open book. You guys are welcome to holler at me anytime you have questions about anything. I am here to answer those questions for you. If you need help building some, if you need help finding something on the platform, whatever it is that you might need help with, I am here to assist you. So holler at me when you have your questions, because that's what I'm here for, man. So what do we think? Do we think that Jerome's going to be... What kind of response are we expecting from Jerome today? Are we expecting hawkishness? Are we expecting him to... He's kind of been a bit of a hard ass over the past couple of times that I've been watching him, just on the past couple of things that he's done, whether it's been an FOMC or it's been just at a luncheon. You know, whenever he talks, he's kind of been... He's been speaking kind of some hardball. And I think a lot of people are kind of on the hunt for him to say something to the extent of, we've taken it too far. But he hasn't come anywhere close to that yet. This is one of the calmest reactions, initial reactions that we've seen in a bit. It would be kind of wild if he ends up saying pretty much what everybody's expecting and markets don't move that much. That'd be kind of wild. You have to expect a bit more volatility once he starts speaking. At least that's what I think. I don't know. What do you guys think? I'm over here just like talking to myself, but I want to know what you guys are thinking. Fake bullish. Tap 425, fall down to 416 and lower. Ooh. Let's see. Let's go to daily real quick. Yeah, so you think this is like take out these highs here, huh? Take out your October 24 highs. Come back into 16s. I could see that. Especially maybe initially. If they really wanted to create some vol, you got to assume that there's quite a few stops up here. I could see that for sure. I like that take, Andy. Me being a price action guy, I've got my eye right here, 431. That's where I've got my eye. Nice little head and shoulders pattern. But that's a conversation for another day. Let's see. Are we live yet? Old boy's going to be live any second now. As soon as he is, I will get this music turned off. And I will get Mr. Powell turned up so that you guys can hear him. I'm going to go back here to this guy. Okay, here we go. Let me get this music turned off. Let me get Mr. Powell turned up. Oops. There we go. Everybody here good?
Good afternoon, everyone. Welcome.
A little quiet.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Go to Howard.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which this the strong economy and all the things I said, that's the context in which we're looking at this question
Markets don't like that.
of rates. So obviously we're monitoring, we're attentive to the increase in longer-term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us. That we would then, that if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So, in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Putting the knife in there.
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and we're not, I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't, but we're not confident that we have. And that is the way we're going to be going into these future meetings, is to be, just determining the extent of any additional further policy tightening that may be appropriate to return inflation to 2% over time.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into this December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial conditions situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that the idea that you would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put our session back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see. If you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby. Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our two mandate goals. We look at that. And we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that you know, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for, I'm sorry, 1 additional
I
hike
think you're
this
talking
year?
about one additional.
Yeah,
No, I wouldn't say that at all. I would say, I mean, the language, you know, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, that's the question we're asking.
So is
So-
it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, you know, and that is the question, and you're right that in September we wrote down 1 additional rate hike, but, you know, we'll write down another forecast, as you know, in December.
Thank you. Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation, and we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You, last month, had gone to York, Pennsylvania, where you talked to a lot of, last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even, just thinking that we really the best thing we can do for the U.S. is to restore price stability. Fully restore price stability and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe, that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left, we think, and I think, we'll still be left with some ground to cover to get back to full price stability, and that's where monetary policy and what we do with demand is still going to be important.
Against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plot's out the window, that every meeting is live with the possibility of a rate increase for right now, doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people on the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change, for example. I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, What I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential. And that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about the meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think one or two additional hikes. So you're close to the end of the cycle. That was an impression a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up, and QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline. And we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
Janelle Marte with Bloomberg. So, in addition to persistence, when you look at long-term Treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy, and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but there are a few of the common ones that people look at, and so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term Treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture, and they do play a role, of course, in many of the major standard financial condition indexes. Your second question was? Banking stress. So it's something we're watching. As you know, we did have, there were issues with interest rate risk and also, funding uninsured deposits in the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the 2s, and the year after that further into the 2s. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in one-year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the UM thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable, and so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think years from now, economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, but ultimately we've got to look at the effects that policy's having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, they have wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back a couple, it comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally, too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation. So far, although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations, become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although that we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is I think clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think we want to see that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had a really, that whole dynamic has been, and also at the same time, the pandemic effects are wearing off so that goods availability, automobile availability is better, or was better. I think it still is. And from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. That took longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So to Daniel for the last question.
Thank you, Chair Powell. Daniel Avis from Agence France-Presse. Just a quick question following up on an earlier one. With regards to the Israel-Hamas conflict, the Fed's financial stability report said the Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take great, really important notice of, but it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. War in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you.
Thank you.
Thanks very much.
Well, and just like that, it is over. How do we feel? Are we all fully asleep at this point? Not as, I don't really know how I feel about that, if I'm honest. Let me do this. Sorry, you guys. Turn this music down a little bit. There we go. We're going to remove that. All right, y'all. So that's really it for me. I don't want to take up too much of your time. I wanted to hang out and watch that. And we're going to call it there. Before I leave, though, any questions from anybody about anything real quick that we can address? If not, then we're going to call this thing. And we'll be back again pretty soon. I can't give you an exact date or an exact event. But we will be back and doing this again very soon. So y'all tell me, are we good to go? Everybody feel good? Everybody got the info that they needed? Some yeses? Some nos? All right, Eco. It's been a pleasure. SDW, pleasure chatting with you. James. Who else we got here? Greg, Patrick, Andy, Alex, Rainbow. Really appreciate you guys all being here. Have a great rest of your day. Andy, great having you. Yeah, have a great rest of your day. Holler if you need me. You know where to find me, at Krutzky Trades on Twitter. I'm an open book. So please holler if you have questions. And again, like I said, we are going to be back doing this all throughout the month of November at the very least. Maybe we'll do it a little bit more than that. But, you know, we're here. We're promoting this awesome sale that we got going on. If you've been sitting on the sidelines thinking about becoming a customer, now is the time. You will not find a better deal. This is the best deal we've ever had. You will not find a better deal on TrendSpider than this. So now is the time to take advantage of it. You guys have a great rest of your day. Thank you so much for hanging out with me. And we will see you all again very soon. All right. Take care.